Australia's inflation rate can't stay out of the headlines, can it? And if you believe the media, we're having a once in a generation inflationary challenge that affects reserve banks and central banks all over the world. So, what's happening to inflation in Australia? What does that mean for your and my budget and for the property markets? That's what I discuss in this week's Property Insider Chat with Dr. Andrew Wilson. So if you want to keep up to date with what's happening in our property markets and our economy, please subscribe to this YouTube channel and click the little bell icon so we can update you each time a new show comes out. Australia's inflation is heading towards 8% according to Reserve Bank forecasts. However, despite what's going to be ahead of another year of slow economic growth, falling wages and a recent budget which really didn't offer any cost of living relief to households, our once-in-a-generation inflationary challenge is not likely to tip Australia's economy into recession. So what's really happening with inflation at present? What's ahead for inflation? And what does that mean for our household budgets and for our economy? That's what I'm going to discuss in this week's Property Insider Chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hi, Andrew.
Good day, Michael. And those latest inflation numbers for the September quarter were interesting, but I think really we'd preempted what was going to be recorded over the September quarter. We did, of course, have another increase in the annual inflation rate. That's the big bogey. Of course, we want to get the worst one out there to fuel our media's desperate need for eyeballs. And of course, headline inflation increased by 7.3%, which is the highest in 40 years since the early 90s at 7.3%. This time, however, it's not oil we can blame to a large degree for that increase, because actually we saw the impact of oil prices lower over or down, no increase over the September quarter. So, but it was the other usual suspects that have driven inflation higher. That was house building costs. They again were high and pushed up that annual inflation, of course, because we're comparing it September this year to September last year, Michael, with those annual numbers. And that, of course, means we came into this inflationary issue earlier this year. So last year was still in that much lower environment. So we're always going to see these rises on an annual basis until we get to when it started to rise, which was the beginning of next year, and we won't be getting annual figures till next year on that. And that's why the predictions are that inflation will be lower next year, because it'll be comparing it to a higher inflation position on that year-to-year comparison. Food, again, was a significant contributor. We've probably got some ongoing issues there in terms of not just supply constraints. It's more related to weather events that have held back some produce, and we're probably going to see a bit more of that coming through as well. But again, we've seen furnishings having a very big impact on that inflation data. And of course, when we talk about furnishings, we know that we've had a very strong increase in demand through the COVID period. That was all about those stimulus initiatives that gave us money. You know, we were paid forward, and now we're paying it back with higher rates. But nonetheless, we've gone out and spent merrily through that period. We continue to spend at very high levels. When we look at the retail sales data, Michael, we can see that it's continuing to grow, not sharply, but still growing. But the level of retail sales at the moment is still at extraordinarily high levels. It's well above where we were during the pre-COVID period. So we're continuing to spend. And of course, it was all that spending that created the shortages of goods that we were spending it on that has activated the inflation data. The boom from home builder in new house building has also increased demand for home furnishings with new houses. So it's like never rains, it pours. Too much demand, not enough supply. Underlying inflation was also now above 6%, which is a record, but they've only been running that underlying inflation measure for the last couple of decades. But it's that measure that the Reserve Bank is looking towards for its target. Its target is a 2 to 3% annual inflation rate on the underlying inflation measure. So it's above 6% now, so some way to go back to 2 to 3%. It was also instructive, Michael, when we look at the quarter-on-quarter change in inflation. Inflation increased, but by 1.8% over the September quarter, which was the same actually as it increased over the June quarter on quarter, but lower than the March quarter, which was up by 2.1%. I think it was also interesting, and this is a positive for Australia, Michael, that when we look at the breakdown between goods and services, at what level they were contributing to the CPI, we saw that it's still more or less a goods-driven inflation rate, which means it is all about shortages of supply, demand not being able to be matched by supply because of those COVID issues. And that reflects the fact that 77% of the CPI reflected goods, and the balance, still small, was services. Now, the component of services has certainly increased towards the CPI. And if I can sort of explain this, the difference, when we look to the US, Michael, which has a more significant inflation problem than we do, we can see that their proportion of services and goods is a lot closer. And when we start to see the price of services increasing in an inflationary environment, it typically reflects higher wages, driving the expectation from those that provide services or passing on extra costs that they have into the costs of their services, rather than a shortage of manufacturing process inputs, right, which we have when we have shortages of supply. So Australia still has a small proportion, rising slightly, of services contributing to inflation. And I think that's because our wages growth isn't as strong as the US, and it's not when we look at the comparison. US wages growth is way above Australia's wages growth. And that's because the US has a different wage setting mechanism. They're a lot more flexible in terms of their wage outcomes. If the boss needs workers, then the worker can bid that up quite quickly. Whereas in Australia, we have a much more subdued environment when it comes to pushing up our wages. We typically have annual or even 2-yearly wage reviews. Enterprise bargaining, of course, which means productivity is an important factor in getting your wage rise. So that means that we don't have this instant response to higher prices that we've had in the US. Now, I guess that's not good because we can't cover higher prices in the short term, although we're sort of managing, whereas the US can. But what it means is we're not getting, at least at this point, sucked into that prices wages spiral where prices rise because they have to pay extra wages, and therefore workers then look at those higher prices, say, no, we want more wages to cover that. And on it goes. And that's the great fear for central bankers, that economies will move into that wages prices spiral. And that will only mean higher interest rates in the US and the UK, which I think is a dead cert, because they have to control it. It's much tougher, obviously, when you're getting into that wages prices spiral environment to get ahead on inflation, because inflationary expectations then start to become consolidated in the economy. Everybody expects 5%, 7% increase every year. And manufacturers and employers start to factor in that as their increase in their cost base. And that's very, very tough to fix without throwing a lot of people out of work, which means without putting interest rates really higher and higher. And I think, unfortunately, if there is the political will, which maybe there's not, or the actual will from central bankers, US, UK, to get to the point where inflation is being tackled by high interest rates, creating high unemployment and perhaps recessions. I don't know if they'll go that journey again, Michael. And if they don't, it means we might get high inflation and a sort of a tapered economy. It's a conundrum going forward.
Well, Andrew, we know there's a whole lot of goods and services in that basket that the Australian Bureau of Statistics looks for inflation, and rent is one of them. And we know that currently rental inflation has been picking up, particularly in our big capital cities, but right around Australia. So that rose 1.3% quarter on quarter. And the other big one was also electricity or fuel costs.
Yeah.
So we know that the cost of fuel at the pump at the Bowser has gone down, but the budget warned that we're going to have some electricity cost issues moving forward.
Yeah, I'm not quite sure how that's evolving and why, Michael, but that probably needs some investigation. It is happening everywhere else, other UK and the US, but what's driving higher electricity costs? It'd be interesting to sort of analyse that. Let's hope it's not the shift to more sustainable energy sources, which, is fair enough, but in this environment, when we're to expect these sharp increases to what is a fundamental good in our households, is very concerning going forward.
When you consider that our population is growing so fast and currently we can't supply enough energy for our houses, what's the challenge going to be moving forward? I guess we're not building enough infrastructure in schools, in hospitals, and currently it looks like even in electricity.
Well, as I said, Mike, I can understand the issue with oil when we've had constraints to supply of crude oil and the COVID interruptions, but I'm not sure what's driving higher electricity prices and whether that's sort of preparing us for the bad news next year now. Has that question been asked? Why? Why are prices rising for electricity?
So it's been forecast that inflation is going to keep rising this year and then slowly start to come down because of the efforts of the Reserve Bank. And as we realise that interest rates are working and inflation is going to come under control, people are going to feel more comfortable. They're going to start making bigger decisions, buying homes, buying investment properties. So where do you see inflation moving forward?
Well, we can look at the budget predictions, the forecasts in the budget. They're believing, firstly, that wages growth will increase to 3.75% by June of next year. Of course, we know they're currently at 2.6%. That's the June number for this year. So that's a really big rise. Treasury have been renowned for how wrong they get their wages forecasts. Of course, there'll be a lot in a high inflation environment. There'll be a lot out there hoping that they're not wrong this time. Certainly the conditions are there. You would expect wages to be higher, having a shortage of labour, a significant shortage of labour in Australia. They believe the unemployment rate will rise to 4.5% next year. It's currently, as we know, at 3.5%.
That's going to create a lot of media headlines, Andrew. But a year or two ago, if anyone would have said we're going to have unemployment at 4.5%, we would have been amazed and thought, no, that's not even possible.
That's correct, Michael. And a lot of it is because we haven't had migrants to fertilise our labour market. We're getting them back in now, which is a good thing. It'll help match the undersupply of labour that we have. Hopefully, that's the government doing its job in matching demand and supply of labour. I think that getting back to 4.5% is not shock and horror, to be quite honest. I think that's still a very low unemployment rate. And I think that what we would see is some adjustment to the participation rate as part of that process. In other words, we'd see more people leaving the workforce, retiring, self-employed, because we have record high participation rate at the moment because there is so much on offer for workers. I think that if we got out of higher interest rates with 4.5% unemployment rate, I think we'd be doing really well if we had inflation under control by then. And the forecast for inflation from Treasury, they reckon it'll peak at 7.75% this year. They're going to be pretty close to that, but it'll fall back next year to 5.75 in the middle of the year. I was a bit questionable about their GDP forecasts, 1.5%. That's quite a low number, Michael. Let's remember that our latest GDP data, which was for the June quarter, was up by 0.9%. That's well below that 0.9%, and that was over the quarter. And they're still predicting there'll be no global recession next year. So we wait and see what happens.
Well, inflation's been in the news for the last year or so now, but that's a sort of deja vu for you and me, because in the old days it used to be in the news all the time, but it's a new item for many people who haven't experienced high interest rates and inflation before. I think it's going to be in the news for some time yet to come, so we'll be regularly reporting it in these Property Insider chats. Thanks for your thoughts, Andrew.
Yeah, thanks, Michael.